If you are sitting there over 45, watching the clock and feeling a little behind where you thought you'd be, hear this clearly. The overwhelming majority of Warren Buffett's wealth was built after he turned 50. The math of compounding can still arrive powerfully, provided you are deliberate about reclaiming lost time. We are going to replace vague financial advice with an exact, specific 7-step sequence. This is the precise order you need to follow if you woke up tomorrow and had to rebuild your portfolio from scratch. Before we touch a single stock, gather 3 things. Pull your bank statements, find every credit card balance along with its exact interest rate, and tally up your actual annual living expenses. Getting these numbers on paper takes you out of a state of financial anxiety and puts you immediately into a state of concrete action. Step 1 is finding your runway number. You have to get brutally honest about your complete financial picture. This diagram shows the formula. You divide your total current assets by your total annual expenses. Assuming 0 additional income and 0 investment growth, this number reveals exactly how long what you have will actually last. Most people over 45 have never done this calculation. When you do, the initial discomfort is sharp. That discomfort is necessary. It serves as the required catalyst to change your behavior. Step 2 is financial triage. Stop adding to your investments, with the single exception of an employer 401k match, and aggressively eliminate every dollar of high-interest debt. A guaranteed loss is the worst investment on earth. If you are paying 18% on a credit card balance, you have a massive leak in the bottom of the boat. No stock portfolio can reliably outpace that kind of guaranteed negative return. Paying off that high-interest balance acts directly as an 18% guaranteed market return. Carrying high-interest debt while trying to build an investment portfolio is a mathematical guarantee of failure. The math requires you to plug the leak first. Step 3 puts the automation engine in place. You maximize every tax-advantaged account available to you by routing your money systematically. If you are over 50, the tax code offers a specific provision called a catch-up contribution. This allows for higher deposit limits designed specifically for people starting late, yet it goes unclaimed constantly. You also need to watch out for income stacking. If you collect Social Security, a pension, and investment income all at once in retirement, you might end up in a higher tax bracket than you are today. Consult a qualified tax professional to see if converting traditional IRA funds to a Roth IRA makes sense for you now. Step 4 forms the core of your portfolio. Put the majority of any money you won't need for 5 to 7 years into a simple, low-cost S&P 500 index fund. Looking at this chart, you can see the historical baseline. The S&P 500 has managed to average a 10% return over the long haul, consistently beating the actively managed funds that drag your returns down with high fees. A boring, simple, low-cost structure mathematically defeats the complex algorithms and expensive management teams on Wall Street. Step 5 is for those who insist on picking individual stocks. Limit your exposure to a maximum of 5 to 8 companies that you understand completely. The ultimate filter for any business is whether its core operation can be explained to a child. If it relies on financial jargon for you to understand how it makes money, keep looking. Audit your current portfolio right now. Check your 3 largest holdings. If you cannot name the CEO or confirm whether management owns a meaningful amount of stock alongside you, you have work to do before adding another dollar. Step 6 is establishing your defensive line. Keep 2 years of living expenses in cash and commit to reviewing your investment plan only once a year. During an inevitable 20% market crash, panic becomes the default human response. A cash buffer removes the immediate pressure to liquidate assets when prices hit absolute rock bottom. Cash is a structural defense mechanism. It protects you from selling your index funds at a severe loss to cover near-term expenses. Step 7 is about your greatest asset. Invest your daily time and cash into upgrading your own earning capacity through new skills, capabilities, or professional certifications. Between ages 45 and 65, you enter a unique demographic window. Expertise has accumulated, income typically peaks, and family expenses drop. During this time, a 20% increase in your salary creates a far greater financial impact than any stock pick. Investing in your personal expertise compounds steadily over decades and carries 0 market volatility. Review your completed checklist. You have an honest financial baseline, a precise plan to destroy your high-interest debt, automated tax-advantaged accounts, and a 2-year cash buffer. Now you need to adjust how you perceive the end goal. Stop viewing money as a raw number and start recognizing it as stored time. Every dollar you earn is the crystallized result of your life. When deployed correctly through this framework, those dollars convert your current labor into a mechanism to claim back time later. This structure secures the freedom to live without financial anxiety. Do not waste the next 10 years waiting to start. Hit subscribe right now, because in the next video, we are diving deep into the exact account structures to activate this plan.